Good afternoon, everyone, and welcome to Broadband Breakfast Live Online. Today's Wednesday, February 19th, 2025. We are excited to welcome you to a discussion about fiber and wireless today. But before I introduce our panelists and our discussion, I just want to say I'm Drew Clark with Broadband Breakfast. We believe in better broadband, better lives. And to us, that means focusing on the infrastructure, but also the way it gets used. We are coming up on the fifth anniversary of this weekly broadcast, Broadband Breakfast Live Online. We've been doing this every Wednesday at 12 noon Eastern Time since the pandemic. I distinctly remember Friday the 13th, March 13th, when we kicked this off, when everything shut down. We're coming up on that anniversary, and we'll be talking more about some of the various many topics on policy, on business, on technology, and how on politics and how they fit together. This topic we'll be talking about today really kind of merges several topics around technology and business, and there may be some policy angles in there too. But we're able to do this weekly broadcast for free, make it available to everyone because of the support from our sponsors. We appreciate all of our sponsors, and we'd just like to recognize Utopia Fiber, Comcast, Ookla, Wesco, Coos Systems, the Institute for Local Self-Reliance's Community Broadband Networks Initiative, the California Emerging Technology Fund, G Fiber, Broadband Now, CostQuest, NCTA, the Internet and Television Association, Gaia, NextNav, and Nokia. Thank you to our sponsors for your support for whether it's a long time or a short time or a recent time. Thank you for that. And we're also super excited about an upcoming in-person event. We try to do an in-person event every quarter, and the event we're doing this quarter is on data centers, nuclear power, and broadband. And that's going to be in Washington, D.C. on Thursday, March 27th. It's obviously a topic that's gotten timely, but we're really going to link together the issues around data centers and the environmental use in data centers with broadband, the middle mile, and the way that we can ensure robust connectivity for high-speed internet. And again, we're here every week on Wednesday. Next week, well, I can't remember right now our topic for next week, but you can just go to broadbandbreakfast.com and click on the Broadband Live tab in the top, and you can always see the next free episode of Broadband Breakfast Live Online that we've got cooking. So let's go ahead and change the view, open it up to our panelists. We are extremely excited to have with us here today, Jonathan Chaplin, who's the lead analyst at New Street Research, and Carla Shaffer, the vice president for wireless at Wesco. Just a little bit more about them and their backgrounds. Jonathan leads the U.S. Communication Service Research team at New Street Research. We're huge fans. Jonathan, you probably know that. We really appreciate the intelligent, insightful commentary on the markets that you and your colleagues provide. Before he joined New Street Research to lead the telecom, cable, and satellite team. He led that telecom, cable, and satellite team at Credit Suisse and JP Morgan, and was recognized as the top-ranked analyst and stock picker by Institutional Investor, Wall Street Journal, and Forbes. And he is a mountain climber. So I share that passion. Jonathan, we'll have to compare notes on mountains we've climbed afterwards. So following Jonathan's remarks, we're going to hear from Carla. Carla Shaffer, again, is the vice president of wireless for Wesco, and she began her career during the era of 1G, and obviously has gone through solutions in 2G, 3G, 4G, and the emerging and advancing world of 5G. She currently serves as the global vice president of wireless at Wesco, global, not just vice president, but global vice president. And she leads a team of experts who support the development and distribution of all wireless services within the enterprise and construction channels. So for today's discussion, as I sort of teed up a little bit, mobile carriers are acquiring fiber providers amid growing recognition of the value of a connected network. And so we're going to talk both from a technical, as I said, and a business perspective around the integration of fiber and wireless, the way operators are integrating fiber backhaul with wireless infrastructure, and the challenges of scaling such integration. So with that, let's go ahead and turn it over to you, Jonathan. We look forward to your thoughts, again, from a market and technologically as well, your perspective on this development.
Thanks, Drew. Thanks for that kind introduction. So sort of a big topic that we write about all of the time, and we've written volumes and volumes on it. And so I'll sort of skim across the surface of the topic and hit a few points that I think are important. And then we can sort of delve deeper on any of these that are interesting to you during the discussion afterwards. But I would say, as a matter of fact, the carriers are pushing the three national wireless carriers are pushing into broadband infrastructure. AT&T has built fiber to 30 million homes. They're now on their way to 50 million homes, and that number could grow. Verizon has been expanding their own fiber footprint at a relatively slow rate, but they just bought Frontier, and they made it clear on the back of that transaction that there could well be more to come. T-Mobile's made investments in Metronet and Lumos, which they characterize as sort of an experiment, as dipping their toe in at this point. If they decide that the imperative for convergence is they've got to scale up those investments in a very significant way. And so what's driving this imperative towards convergence is sort of three things that could be behind it. Number one is some of the carriers believe that if you offer two services together, your market share goes up and your churn goes down. Number two is broadband assets at the moment are very cheap. Wireless assets, by comparison, are quite expensive. And so if you had a wireless business trading at a high multiple, using your cash flow or currency to buy broadband assets that may be undervalued right now might be just a very good investment decision. Even if there were no synergies between these assets, using wireless cash flow to buy broadband assets might just be a darn good investment right now. And then the third one is that we're getting to the end of an era where the FCC can find more spectrum to release every 5 or 6 years. It's getting harder and harder to find bands of spectrum in the frequency range that's most useful to the carriers to release. We've got an ambitious objective from this FCC to release some chunks of spectrum to the market. There's sort of 3 pieces of spectrum on the table. And out of those 3 pieces of spectrum, there's a real possibility that none of it is available over the course of the next decade. Even if all of it was available, it would barely keep pace with what the carriers are going to need. And so as the carriers look at a future where less spectrum is available, the alternate way to increase capacity on their networks is to densify it. If you own the underlying infrastructure, the fiber, then densification is quick, easy, and relatively cheap. But if it's an input cost for you, it could be incredibly expensive. And there could be a big difference in the margin and cash flow for an integrated business versus a standalone wireless business, if that's what the future of spectrum and capacity looks like. As I think of these 3 different potential drivers of convergence, I think number one is nonsense. I don't think that putting multiple services on one bill has a material lasting impact on churn or on market shares. We've got a lot of evidence from Europe at this point on what convergence has done for market participants. And for market participants, it's done absolutely nothing. For equity investors and the market participants, it's done absolutely nothing. It's been tremendous for investment bankers and lawyers and to some extent regulators. But if you look at the data across multiple markets in Europe where there's been convergence, if you look at those that have participated in convergence and those that have sat it out, whether you look at longitudinal data for individual operators or market level data, whether you look at market share of subscribers, EBITDA, free cash flow, returns on invested capital. Even if you look at just the precursor metrics like ARPU and churn, there is no discernible lasting benefit from convergence on any of those things. The carriers, by the way, in Europe have claimed the same things that the carriers in the US do, that they see a causal relationship between multiple services and churn. We think it's just selection bias, and the data seems to bear out that it's just selection bias. If for companies like Virgin Media in the UK, we've got a decade's worth of churn data where for a decade they've claimed that as we bundle, we drive down churn, and they've gone from like none of their customers being bundled to virtually all of them being bundled, and churn has been unchanged over the course of a decade. So the first category of convergence benefit we discount. Carriers ought not to be buying assets on the basis of imagined churn benefits and market share benefits. The second convergence benefit we're big believers in. We think the value of assets ought to be shaped by market structure, and the market structure in the broadband market is much more compelling than the market structure in the wireless market. And so broadband assets should trade at much higher multiples. And today they don't, they trade at lower multiples. And so this is a great opportunity for companies trading at higher relative multiples than they should to pick up great assets at relatively lower multiples. And T-Mobile is very clear that this is part of what's animating their investment decision in Metronet and Lumos. What they say is, like us, they're very skeptical that convergence drives lower churn or higher market shares. In fact, that isn't animating their investment at all. They think that their investments in these assets are going to be great investments. They're going to make a great return on these investments because they're getting good assets at what they think of as a reasonable price. And so even if there are no synergies between the assets at all, they're very happy with the investment. And then they're going to use this investment to explore the third category that I mentioned, which is the benefits of integrating a fixed and mobile network in terms of your ability to scale up capacity quickly, cheaply, and efficiently. Now, the market broadly doesn't agree with this as an investment thesis. There's a very efficient market that is valuing broadband assets at lower multiples than wireless assets, and the market would tell these carriers not to stick to their knitting, to allocate resources to the business they're in, and if they run out of things to invest in the business they're in, to give the cash back to investors to invest in other businesses. That they would say that isn't the job of carriers. So the second category, while we believe in it, is certainly very contentious. And then the third category is unproven at this point. So the carriers are still working through all of the spectrum that they got from the 5G auctions. They're not at a point yet where they're spectrum constrained. And so they're trying to imagine forward to an era where they might have run out of spectrum, the FCC's got none to repurpose. And how could the economics of networks change in that environment? How critical could fixed infrastructure be in that environment? It is nerve-wracking to allocate capital to a use case that is sort of completely unproven at this point. Like theoretically on paper, it makes a lot of sense. it's not going to be proven out for the next 5 years. Most of the CEOs at these three companies, like all of the CEOs at these three companies, are probably not going to be there 5 years from now. And so allocating capital to a use case which might not be demonstrated for the next 5 years is difficult. If it wasn't for the fact that these were great assets trading at cheap prices, I think it would be really difficult for the CEOs of these companies to make the case for making these investments. But because even if that future use case doesn't pan out, you're buying assets at good assets at attractive prices, where you'll probably make a decent return. It gives the management teams insurance to go ahead and do those deals today. So that's kind of the lay of the land as we see it. AT&T strategy is very clear cut. They're doing the vast majority of their push into fiber organically. They've got the biggest wired footprint among the three today, and so a lot of infrastructure that they can upgrade at good economics. And then they've made this investment in Gigapower, which is building out a footprint. And they've said that Gigapower may do acquisitions. Verizon is well behind AT&T even after the Frontier acquisition. And so the question is, what do they do next? They're a little bit balance sheet constrained. And so there's a question of what can they do next? And then T-Mobile is the furthest behind with investments in two really small assets today. Our assumption is T-Mobile works through their experiments with Metronet and Lumos, and examines the benefits of integrating a mobile and a fixed network together. If they come to the conclusion that convergence is indeed an imperative for network-driven reasons, not for churn or market share-driven reasons, then they have to do something much bigger than what they've done this far. And the sort of the only assets out there that would really move the needle would be Comcast or Charter. And so that's a transaction with a real possibility over the course of the next 4 years, as T-Mobile sort of works their way through their work on the assets that they've already bought. Drew, I think that gives you sort of a pretty clear picture of the lay of the land as we think about it. Happy to dive into any of these topics in more detail after Carla's spoken.
Excellent. Yeah, we'll do that, and it's prompted many thoughts. And Carla, again, I know, feel free to lay the issue out from your perspective, but like zeroing in on number one, number two, number three, I can definitely see how, the actuality of a converged network is the issue you're wrestling with. But Carla, let's turn it over to you to lay out Wesco's view of this topic.
Great, thanks, Jonathan. That was really interesting. Actually, love to sit down and just break some bread, because so I've been in the industry now, I think for 26 or 27 years, just watching the evolution, wireline to wireless, and then a little bit back to wireline now has been really fascinating. And look, I'm wireless. Started at Sprint PCS, right, back in 1998, and then went into wireless broadband probably in 2008. And at that time, the wireless broadband technology was very limited, right? We had some solid point-to-point, low bandwidth, low capacity, high latency, but it got the job done, right? Then we got millimeter wave, certainly helped, but maximum 1 gig. That made us very happy back then, and it was expensive. It's what we could do. Then, free space optics really didn't work well. And now we fast forward, right, 15 years, and the technology has had tremendous advancements. Is it ever going to replace fiber fully, depending on, in a big data center? No. Can it augment? Yes. And I think that's what we're seeing now really is a lot of that recognition that wireless needs to be wireless and wireline. The ideal network is a converged platform. Because you still need fiber, you still need wires. I don't care what anybody says, right? When you have a wireless network, the best wireless network is connected by a strong fiber backbone and infrastructure with power, right? You need fiber, you need power. And I agree with you wholeheartedly. I think AT&T, they came into the world at a good time, in a good place. Their foundation is fantastic, right? Historically. And Verizon and T-Mobile, they're going to have to, if you will, keep up from that perspective. But to have it, to be able to lay out, to be able to grow from it, is critical. And I think you see that the big tier ones, from a mobility perspective, they've saturated the market in the US, really, for the most part, right? Now it's just because for a long time it was new subscribers, new subscribers. How do they manage the two things that are most important to them? Their ARPU, and more importantly, their churn. Can't keep their ARPU, right? If churn is up. So how do they do that? And when everyone's always offering a new phone, a new device, a new plan. So they had to start looking for other ways, new lines, new streams of revenue, right? And how do they build on that? And so we're seeing Verizon look into other areas. We're seeing, in more on the cellular and the mobility side, in private networks and things of that nature. But it is really critically important, I think, for any organization to not dismiss. If one is heavy in wireless, they need some wireline infrastructure. If one is heavy in wireline, they need to look at wireless infrastructure. And I think we're seeing, when BEAD first came out, there were some parameters around the funding and how it could be used and what technology. And I think we're starting to see some of that alleviate because of the fact that we really can't reach the entire country and every location with fiber. That's just not feasible. So how do you build in the wireless technology, right, in your business model? Okay, I can get fiber to strategically lay out the plan. Where do I need to run that fiber backbone? Where can I hit wireless, with the wireless technology to just A, get connectivity to these poor people, B, start the line of revenue, right? And as time goes on, have a plan to now, all right, now I can afford fiber to that. I can take this wireless infrastructure farther out. And that's one way of doing that. And then another way is just when you look at disaster recovery, we've been hit back-to-back storms all over the country, not only in the hurricane zones, but also these fire. They destroy everything, right? What's the fastest way to get a system back up and running? It's going to be via wireless technology. And in some of the areas that are going to be hit over and over again, the technology is sufficient to support residential neighborhoods, right? And so, and it is less expensive than running an entire new fiber backbone. So I think we're seeing companies starting to rethink how they redevelop, right? Their networks and their technologies. And if they haven't looked at the convergence, I think that's why you're seeing that today, because they really have to keep up with everyone else.
Well, again, this is fabulous discussion, and I want to drill into both, like I sort of started to say at the beginning, both the business and the technology aspects. For Jonathan, let me just start with a question about value of fiber versus wireless. And, and I think you said something like this later on, but my understanding has always been like the physical value of a home with fiber versus a home that's got a wireless connection. And by extension, the value to the owner of the fiber asset versus the value to the owner of the wireless customer and the relationship in the network is considerably higher for fiber than for wireless. And you may be saying that, but then to what do you account the overvalue of wireless assets versus wireline assets right now, Jonathan?
So it all comes down to market structure. Because the costs in these businesses are fixed, and they're really, really capital intensive, whether you're talking about wireless or fiber, the sort of the defining characteristic of these businesses is high capital intensity, high fixed costs. There's a pool of revenues that's available in the market, that's growing at a call it a low to mid single digit rate. the number of times for every operator in the market, you're replicating an entire base of fixed cost and capital requirements. So if you take that revenue and there's one guy in the market, they generate a phenomenal return. If you split that revenue two ways, the return goes down dramatically. If you split it three ways, it goes down even further. To give you a rough rule of thumb, if you look at it from the perspective of either returns on invested capital or the value of the asset, it halves every time you add a competitor to a market. So take a monopoly divided in two, the value of the asset halves. Add a third competitor, and the value of all three assets halve. Add a fourth competitor, and the value of all four assets halve. And when you go from two to three in an average market, you're going from earning an attractive return to not earning your cost of capital. So think of that as like the defining characteristic of economics in fixed infrastructure businesses like telecom. The multiple that you will pay then is really a function of, well, how many times are you dividing that revenue? In the mobile market, and I'm talking here about the mobile market, not fixed wireless broadband, which I think is separate. In the mobile market, you've got three national carriers, and then cable competing for that business as well, and then Dish trying to compete for that business. If we ignore Dish and just think of it as three national carriers plus cable, it's a four-player market. In four-player markets, your pricing is always going to navigate towards marginal cost. Your returns on invested capital are always going to navigate towards the cost of capital for the market overall. Broadband is historically been a two-player market. You've had cable and a telco in every market. That's a much more valuable market than a four-player market because both operators are always going to be able to earn above their cost of capital. There's always going to be pricing power and discipline in a two-player market. When the wireless carriers launched fixed wireless products, the market structure became unclear and still is unclear. Is it now a five-player market? Because in every market you've got a cable provider, a fiber provider, and then three wireless providers? Or are the three wireless providers limited to a portion of the market so that most of the market is still a duopoly? If it's a five-player market, it deserves to trade where it's trading today. If the fixed wireless product is limited and most of it is a duopoly, then all of these assets are undervalued. And the equity market has said, well, we don't know what the correct market structure is here. And for now, we're going to make the assumption that this is a very competitive market, even more competitive than mobile. And so that's what's reflected in asset values today. Our view is that fixed wireless capacity on mobile networks is limited, that they can't economically add capacity for fixed wireless. And so at most, you've got 19 million households that could be served off of wireless networks today at the very top end. And so that's somewhere around, call it 12% of the overall market. The remaining 88% of the market can only be served by fiber and cable, and so remains a duopoly. And so our view is that all of these assets are undervalued today because the equity market's concerns about the market structure in the broadband market are unfounded, and most of it will remain a duopoly. So that's the thesis.
Wow. Excellent elucidation. Carla, how do you kind of look at this? I mean, again, and talk just a little bit more about the role Wesco plays in supporting your customers with either kind of the wireless or the fiber end of things, and how this kind of equation going on in the markets right now impacts the builders of the network who are thinking, should this marginal entity kind of go to a fiber build or go to a wireless build?
Yeah, it's a great question. And those are interesting stats, Jonathan, because I wouldn't have pegged it to be such a low number from a wireless like capacity perspective. So Drew, what we do is we look at the customer. What do they need, right? What do they do? What is their function in life, right? And in business. So if it's a commercial play, most commercial businesses, most need fiber without a doubt. They need the capacity, they need the bandwidth, right? It's the best latency. That's fine. When you move into the smaller markets, right? Two areas, smaller markets, and I'm talking rural, right? And we look at residential. That's where fixed wireless makes a tremendous, tremendous, tremendous play for two reasons. One, and I live in a small market. I have one option. I don't like that, right? So Jonathan, you mentioned like duopoly. At least you have two options, right? Because the best thing for anyone is competition. There is no competition. I'm stuck. I pay a lot, not thrilled with it. But I'm stuck. And when the service isn't quality service, and a lot of times I don't get the best internet speeds, I'm stuck, right? I would love to have a fixed wireless access option, because for what my kids have moved out of my house. When they were here, that was a different story. So you have to look at all of those dynamics. Like I do work from home though. I need good quality that's dependable, reliable, that can hold video. Fixed wireless can do that today, right? For one person. Now, can they do that with 3 or 4, streaming teenagers in the house? No, they can't do that then. But they can for one person, 2 people probably. So you look at that, what are we trying to accomplish? So we do a lot of that upfront planning, right? What is it? What exactly? It's almost like it's really an equation. You should take that information and you determine, okay, what do we want? What do we want to accomplish? What do we need to deliver? And then you map it out. There are great tools from an outdoor build perspective to map out what that looks like, what the costs look like. With everything that's happening right now, right, you really have to, if it's a new build, got to really take that into consideration. And what can we, possibly deliver? And so that's what we do with our clients, with our service operators, with the enterprise customers as well. And we give them all of that information. You also need to understand like who is in the market at the moment. We do see a lot of, I'm not sure if I would call it partnership, but we do see a lot of like maybe renting capacity. So one operator may have access. The other operator, it's fascinating to me, will actually rent it, right? The accessibility to that location and sell it to that customer, which I find fascinating. I don't think the customer knows. Maybe they have a service agreement, right? Contracts are really critical and important. That's the one thing that I'm finding today. Customers have contracts with entities that they trust. They do bundle services. So Jonathan, to your first point on the different, what I would call back 10 years ago, it was the triple play. I think today you're right. It's a double play, wireline and wireless. In the triple play era, they were adding the cable TV, but today there's so many subscription models. I don't think that's really relevant anymore. But I do think that having a contract, I think when an enterprise has a contract with an operator, the more they can bundle and put under that contract, that seems to be really attractive to them. Beyond just wireline, wireless, private networks, because they don't know how to do that. Customers they don't know how to be a telco. We're coming into an era where we are enabling customers to be their own telcos because they can get their own private network, right? And spectrum, but they don't know how to. Right. So that's kind of where we come in, because we can help customers. We can, if they really want to do that, and they will need to hire some sort of internal team to do that, we can help them with that. And we can help them with that whole transition. And then they own it's theirs, right? For a big company, for anyone that has security issues, for anyone, really just security issues is probably the driving piece there, that wants to retain their data and then do something with the data, which is where AI comes in now, right? Because in the past, it was great to have all this data, but what are we going to do with it? Well, today you have AI, right, and software that will help you do something with that data. So becoming your own network provider and keeping that information is becoming more viable and important, but they don't know how. So there are options, right? An operator can actually, you can go to Verizon and AT&T and buy a private network from them and let them manage it all for you. And so that's kind of where we come in, is helping customers determine where do you want to be in the next? It's not just a 1, 2 year, it's 5, 10 years. And making those investments and those right decisions today is a critical. They don't want to change down the line, and they don't want to miss out, and they don't want to have to pivot.
So thank you. And we've got a number of really great questions building off on these as well as going into other areas. One thing I just want to pick up on, I think you mentioned, Jonathan, briefly at the start about spectrum availability, right? And is it your view that there's a kind of a constraint right now because there's a hearing right now as we speak, actually it's just concluded on the Senate about this very issue, and there's a bit of a battle between those who want auctioned spectrum, namely the big wireless carriers, and those who are saying, no, we need to kind of preserve spectrum sharing and the like. And I'm just wondering if you could speak to the availability of frequency and how that plays into these valuation levels that you've laid out and we've talked about, Jonathan.
Yeah, a question I get all the time is the spectrum coming available. There's an opportunity to invest in fiber. Which one should the carriers be focused on? And the answer is both. They should buy every piece of spectrum they can get their hands on when it's available, because we're going to run out at some point relatively soon. And I think of spectrum is future market share. Your spectrum share is indicative of where your market share is going to be in the future. But because we're going to run out of spectrum, they also need to be very focused on picking up infrastructure assets as a future means for creating capacity, because there is a scarcity of fixed infrastructure assets as well. And so, there's a one-time opportunity to pick up what's there. And if you miss out, it's going to be very difficult to replicate that asset. And the reason is because every market has two fixed infrastructure assets, cable and a telco. For AT&T and Verizon, they can't buy a cable operator probably, and so they're left to the telco assets. And so there's one asset in every market that they can own, and there's two of them. So there's a scramble for both categories of assets, and they're both imperative. As I think about the bands that are becoming available, is the upper C band. There is 3.1 to 3.45, and there is potentially another broadcast auction. And that's everything below 6 gigahertz that has some potential to be cleared and sold to the carriers. And the overarching thing is, I would say there's a chance the carriers get none of it. You'd have not just the advocates of sharing and sort of open access clamoring for all of that to go along the lines of something like CBRS. But you've also got satellite with a very powerful voice in this administration clamoring for spectrum. And then you've got the carriers clamoring for spectrum. So what amongst those assets actually gets cleared and sold to the carriers for exclusive use is unclear at this point. The upper C band is the piece that's most visible. There is a hope we can clear at least 100 megahertz and sell that to the carriers, although there's a fight to be had there amongst those three different constituents and the FAA, who's going to be worried about interference with altimeters.
Right.
The carriers would like all 200 megahertz of it to be cleared and sold to them. I think there has to be a fairly significant guard band to protect the altimeters. But at least 100 megahertz is the opportunity. Think of that 100 megahertz as roughly a 10% increase in supply. The increase in demand is more than 10% a year. So that's 1 year's worth of demand. So fantastic if we release it, not enough. 3.1 to 3.45, unclear whether they'll ever, it seems unlikely that they'll be clearing in that band, although this administration is taking a very aggressive approach to both dealing with the Department of Defense in general and in going after what have sort of historically been sacred cows. So there's a chance, but I think it's very difficult to clear in that band. There's a much better prospect for sharing in the band, but the amount of capacity that could be made available on a sort of a national average basis, I think is still very, very unclear, and the time frame is very unclear.
Let me, sorry, finish your thought here.
I was going to say, and then you've got broadcast. The process for that is really only just kicking off, and it's a politically charged process as well. That could easily take the better part of a decade to run its course.
Yeah. Drilling in just a tad more on this topic, Michael Calabrese asks the question. He reviews some of these bands and this upper C band, but he asked this great question. Given the convergence scenarios that you've been speaking about, Jonathan, do you think the big mobile carriers would be better to invest big sums in that spectrum or in the densification of existing spectrum? Will investing more in fiber and cell sites always be a last resort for mobile carriers? What do you think of that question? And Carla, I'd love your thoughts too on that.
Yeah, so the answer is both, Drew. They need both. They absolutely need to pick up spectrum where it's available. And then because there isn't going to be spectrum available forever, they need to be investing in fiber simultaneously. I think by the way, there's one other block of spectrum that we haven't discussed here, which is Dish. They're sitting on 140 megahertz of nationwide spectrum. It's the best of all possible spectrum that's available to the carriers. Unclear whether they're going to make it as a business. If not, that's the first block of spectrum that probably goes back to the carriers and gets folded into the networks of AT&T, Verizon, and T-Mobile. But I would think of money available for spectrum being entirely a function of the carriers' balance sheets. In 26, we think they'll have $100 billion to spend on spectrum. By 28, it'll be $160 billion that they will spend on spectrum. And how much of it goes to the three bands plus Dish that we've spoken about is purely a function of what the FCC is able to release in that time frame. But if the only band of spectrum that gets sold was the upper C band and it's 100 megahertz in 2026, I would bet you that fetches $100 billion because that's what the carriers will have available in balance sheet capacity in 2026 to compete for it.
Carla, how do you kind of look at this question? And, if you'd like to elaborate on that, feel free, but also interested in how you help and discuss with providers the sort of the implications of integrating the fiber backhaul with the wireless infrastructure at scale. Maybe kind of going to that second part of Michael's question about densification of networks.
Yeah, sure. And I agree 100%. Look, the operators have to buy the spectrum when they can because we're running out of it. So without a doubt, I mean, that you almost have to kind of prioritize that. And it's tough because it is a function of both. You need to densify the network as well. Like you can't not do either of them. It's not an option, but you have a limited time to acquire that spectrum. Otherwise it gets bought off. So what we do is, and that's just agreed to Jonathan, right? The balance sheets and hopefully they're managing their cash flow and everything well so that they have the funds. And you generally see, right? Verizon was the biggest winner in the last C-band auction, just based on like how they managed, what they planned and how they managed. But from a fiber densification, we go in alongside with the operators and look where your biggest pain markets, right? Where are you getting the biggest complaints? And then how do we lay that out? Where are the assets? That's the problem. One of the biggest problems is where can you put stuff? So we don't really want to build a lot more towers anymore, but there are still towers being constructed. There's a lot of opportunities to partner with utility companies, right? Do you have to have a tower? Can you use poles? There's a lot of, aerial fiber. It's not all about running underground fiber. That's ideal, I would say. I think everybody would like that, run to their house, but you can't do that everywhere. So we look at the topology, we look at the geography, the climate, the market, who are the contractors, right? What's the availability? What's the skill set in the marketplace? That's a big problem, right? That we're on the cusp of facing is the skill set and the labor force. And there's been a lot of challenges, around that in regards to when is the BEAD funding going to deploy? You can train up that we've got younger generations that need work, right? That's real. But you can't train them up if they're not going to start working because they'll lose that skill set immediately, right? So there's a lot of complications that you got to take into consideration. And that's just some of the stuff that we do.
Carla, one of the kind of topic points informally and more formally over the last month since the administration's been in place is, will there be changes to BEAD in regards to the quote fiber preference? Now, again, this always needs to be put in context. The BEAD program has always been about multiple technologies. While it does kind of start with fiber, there's clearly been use cases for wireless and even for LEO satellites. But could you just speak to how this discussion impacts those who are considering, hey, do I deploy fiber to this area or wireless to this area?
Yeah, it's a great point, because I think from the beginning of BEAD being announced several years back to where we are today, it's really down to the state, to be honest with you, right? Because the state can make really good cases and has in a lot of instances where they have gotten the exceptions. And I think that it's actually been it's been, in most cases, it's been removed, that the fiber requirement has been removed and wireless technologies is allowed from a BEAD perspective, because it's the only way that, I think there's one state, I think it was, that stated, we're not going to use any wireless. It's 100% fiber. This is a very difficult topology where they reside in. So it's okay, that's a logical decision. But so much of the rest of our country really needs both to maximize, right, the efficiency of the BEAD funding, to get that business developed, to get the revenue streams rolling. So we are seeing a big impact. Now, at the end of the day, until the projects start rolling, right? I think we're stuck at the moment, and hopefully this is the year, and hopefully the administration and the states can get the resources that they need. I think that's what it's been a challenge for them, is resource constrained. They're not telcos, right? The state departments that run it, they're not. So they're challenging how to become a telco. But I think they've made a lot of advancements, and hopefully we see some of that roll out this year.
We have two real nuts and bolts questions about finances, and let me ask both of you. Dan Smith from Hawaii asks, what are the budgetary prices and of the components of fixed wireless? And he's talking about, customer premise equipment and base equipment. And his hypothesis he's asking here is social and economic benefits to wireless now, fiber later. How do you look at that issue, Jonathan and Carla? And what would you say to people thinking the way I think Dan is here?
So I'll give you my perspective. So as a starting point, the discussion around fixed wireless, I think, can often get confused. I think that, like, the sort of law of the future network is that all networks will be fiber, and all devices are going to connect to those networks wirelessly. Every network has to incorporate both fiber and wireless. I would bet that the vast majority of people on this call are connected in exactly that fashion. They don't have a hard connection into the side of their computer. They're connected over Wi-Fi to something that's ultimately a fiber network. So it's not. We shouldn't look at these as competing technologies. They're both a critical piece of our connectivity infrastructure, and always will be. It's just a question of, should that connection over wireless be 10 to 100 feet or a mile and a half? And the answer to that question is going to be entirely use case and site dependent. And so, there are situations where either the use case or the economics argue for wireless over fiber. If you're looking at the fixed cost of a wireless network, the cost of adding capacity to that network is high and growing because, spectrum's becoming more difficult to come by and more expensive as a result. Densification is more difficult for all of the reasons that Carla listed, and upgrading to the next G is incredibly expensive as well. When you in the context of current spectrum, current network density, and the current G that's deployed, there's a limited amount of capacity on a wireless network. And that capacity generates 50 times the revenue per gigabyte for wireless customers than it does for fixed customers.
Wow.
Something that everybody should have in mind is you think about fixed versus wireless, is that wireless networks today in aggregate carry 5% of the traffic in the country. 95% of that traffic is being carried by fixed networks. That 5%, if you were to sort of double the usage on wireless networks overnight, they'd be brought to their knees. They would cease to function. There is always going to be a limit on the amount of capacity on those networks as a function of these three inputs that we've discussed. And the revenue per gigabyte is always going to be much greater for mobile customers than it is for fixed customers. And so as a function of those two facts, what the wireless carriers have to sell off of their mobile networks for fixed wireless broadband is the excess capacity that won't be required for their mobile customers. And so you've got to take a forward-looking view of, what's my spectrum density and network efficiency going to be in 5 years from now, and what's the demand of my mobile customers going to be 5 years from now. My total capacity less that demand is what I've got to sell in the fixed market. If you're looking at fixed mobile networks that are purpose-built for fixed wireless networks that are purpose-built for fixed wireless, it's a totally different equation. If you've got millimeter wave spectrum or 3 gigahertz spectrum, and you're building a network that's specifically like what Starry was doing in a lot of dense urban markets, or what we're seeing a lot of WISPs do in more rural markets, the economics of those networks is totally different. I think there's something really important in Dan's question, which is we can get decent broadband to 100% of homes today using Starlink. And it's taken us 4 years to get broadband to not a single home using BEAD with a fiber preference. There's a real trade-off here that we have to consider. If you're looking at it from the perspective of the household, and they can have Starlink today or fiber in 10 years, what are they going to choose? They're probably going to say, give me Starlink today. If we're looking about the economic value of deploying all of this infrastructure that we can only ever deploy once, and the jobs that it creates in the deployment phase, and then the economic opportunities it unlocks on the other end, deploying fiber is very good from an industrial policy perspective as we think about the infrastructure for the country. But we're asking households that aren't connected today to continue to not be connected while we go through this deployment process that'll take a decade. And that's a very difficult trade-off to weigh. I'm not really equipped to sort of judge how we should be weighing that trade-off. I think it's very challenging. If the decision is made in one direction or the other, I can tell you what the most economic way of sort of serving that objective is, but I'm not the guy to sort of figure out which of these objectives is most noble.
Carla, how would you answer Dan's question about the budget comparisons of fixed wireless and other scenarios?
So I would say so fixed wireless is coming down tremendously. I mean, you can get a cellular router at your home now that serves the purpose. So as a parent of a 20 and a 22-year-old, we were living and breathing, right? COVID. My kids were in high school at that time, and their friends, and just seeing the disparity was eye-opening. I didn't realize, and it was really unfortunate. So so I agree with everything that Jonathan says, right? The infrastructure, the fiber, that's great, but if you can't get to it, can't sacrifice your kids, not just education. So these devices, Steve Jobs in particular, when he created, because this was what changed the world, right? And it changed the dynamics of how our younger generations do everything, including communicate. I mean, forget from a business perspective, because it certainly impacted us in that respect, but it's our younger generations, and you have got to enable them to have access to this technology, even if it's not the most ideal speeds, because it's not just a learning function from an education and what you're doing in school. All the different apps, all the different creativity things and collaboration. It's how they communicate today. I don't love that, by the way. I wish they didn't. I wish they would have more face-to-face conversations. But at the end of the day, we have to all evolve with the technology and how they're integrating into it, because they're still really bright kids, right? They're still really amazing generations. They just have a different tool in a different way, and we have to work with that. So we have to give it to them. And if we can't get them the fiber in 10 years, okay, then we got to address the fixed wireless access. So I would say from a hardware perspective, couple $100, higher end $1,000, and then you'll have your monthly subscription fees.
All right, one more technical question, then we'll give each of you a last chance to weigh in with anything else. This is from Randy Leaning, and he's got a number of concepts here, but to try to summarize, he's pointing out that fixed wireless access get bandwidth on a secondary basis relative to mobile subscribers. And it means that fixed wireless subscribers do not have the predictability of speeds that other, fixed wire-based users enjoy. On the flip side, fixed wireless is normally less expensive than cable or fiber. So it may be good enough for price-sensitive users with modest needs. How do you two, in your respective vantage points, view these kinds of trade-offs in this question? Jonathan.
So I think it's great that fixed wireless is available, and that it's available at around $30 a month for households that are price sensitive, and are willing to compromise on speed and reliability. The other thing I would say that fixed wireless has revealed to us is that very few people actually need a gigabit per second. That the needs of most households are much less than what we've been convinced to pay for over the course of the last 5 years. What's really interesting is if you look at the consumer SAT scores on fixed wireless, they're fantastic. People love the product once they get it. It's way higher than fiber even, and it's like demonstrably a worse product than fiber if you put the two side by side. There are a couple of things that are driving that consumer SAT score. One is that people have hated their cable companies for a long time, and so when fixed wireless rolls in and they've all of a sudden got an alternative, they're delighted, they're overjoyed, and so it doesn't fully reflect the product relative to cable or fiber. It reflects the fact that choice has been unlocked in these markets for the first time ever. There's also like a bit of the brand halo of the national carriers that flows over into how they think about the fixed wireless product from those carriers. And it's a brand new product with networks that are relatively unloaded at the moment. And so people are experiencing the best version of the product today. But what it tells you is, those households are all only getting 100 megabits per second. They're very happy. There are a lot of households out there that don't need a gigabit or multiple gigabits per second to serve their needs.
Carla.
So I would argue it depends on the market. And if you look at a market that has become oversaturated, you can take like Florida and Southern Florida, for example, because everybody moved there. Cellular connection is challenged at best. So that's probably a market where fixed wireless access, not a good option. Go out to another rural market where you don't have a tremendous amount of density from a user perspective on the network. it's a fantastic option, right? And so it really depends on the market where you live. I mean, and a good vantage is how does your cell phone work itself when you're trying to stream a service or do a video call or do your FaceTime. That's a really good marker as to what you can expect from a fixed wireless access connection. And if that's good, then you know what? You probably have a really good alternative. If, to John's point, if it's an option. For example, in my area, it's not. So stop.
Yeah. Well, this has been an extremely illuminated conversation. As I said at the start, a little more business and technology than policy, but that's fine. What are your final thoughts? And let me just tee this up by what do you expect in 2025, Jonathan and Carla, on the business, on the technology, even the policy front in this question of fiber and wireless together? Jonathan.
So 2025 is going to be really exciting. We're going to see not actual spectrum auctions, but the process that sort of precedes spectrum auctions work their way through in 2025 on all three of those bands that we've discussed. We're likely to see, the organic plans of the three carriers, I think, have been pretty well laid out in the fiber space, but we're almost certainly going to see more consolidation, more deals. Certainly amongst the smaller players in the market. And then there's the potential for that very big deal with T-Mobile that I mentioned earlier. And I think the further out you go, the more likely there is to be sort of bigger, more transformative consolidation behind this convergence theme.
Great. Thank you. Thank you for being with us, Jonathan. Carla, final thoughts that you have.
I think we're going to see a lot. I think we're going to see the continued swell of fixed wireless access because of, unfortunately, just policy and BEAD funding still being stuck. Companies, operators absolutely have to have a plan. They have to continue to make the right investments. But from an overall perspective, I don't think we're going to see that layout quite just yet. So connect with wireless.
Well, thank you again to our panelists. I did put in a link, and we'll put it on the page, a webinar we did with Carla last year on some aspects of this. Next week at this time, we're going to be talking about copper theft and broadband vandalism. And then on March 5th, we're going to be talking about the future of data centers, which will tee up our March 27th summit. On behalf of Jonathan, Carla, and all of our viewers, I'm Drew Clark, and we'll see you next week. Take care.